We've seen rates spike up extremely fast, extremely hard, and then they kind of cool down. Now they're going back up. They look like they're going to stay up. Hey guys, welcome back to the channel. This week is going to be about something that I've been seeing all over the place, which is the rise of treasury bills and CDs, and just kind of what that means for the residential real estate market. Before getting into that, last week was the first week that I actually did a behind the scenes deal where it wasn't just a macro idea. I actually showed you guys real numbers, a real property I actually bought, my own house hack. So going forward, just the structure of the Substack and the videos are going to be back-to-back weeks. It'll be a deal I've actually done. So I'm going to start showcasing all the deals I've done and then behind the scenes of them. And then it'll be followed by a macro idea of the market, kind of similar to what this one's about, which is treasury bills exploding, CDs exploding. So let's get into it. Okay, before I go into this, I'm going to explain what a T-bill is. Basically, it's just a government-backed debt for 1 year or less. So you would say you put in 100,000, and as of right now, the percentage is 5%. You get 5% on your money for, let's just say you do a year. So that's how T-bills work, and they're essentially guaranteed. They're backed by the government. Why is this important that T-bills have been going up so high? As of now, it's at 5.1%. This is important because the people that I've been talking to, and just even how I feel personally, there's a ton of uncertainty. Over the last year, we've seen the stock market crash. It's coming back up. I don't follow the stock market too closely. We've seen rates spike up extremely fast, extremely hard, and then they kind of cool down. Now they're going back up. They look like they're going to stay up. So this is important because when there's a lot of uncertainty, it's not a bad idea to just turn and go, why don't I take my foot off the gas for a second and kind of wait it out? I think a lot of people have a wait and see approach right now, myself included, where if you do have some money, instead of rushing into stocks or real estate investments or any other type of investments, people want to see how the landscape is going to play out. So they maybe will do a T-bill, guarantee 5% on their money for a year, and reassess the situation, reassess the economy a year down the road. I like to think of the concept return of capital. So return of investment instead of return on investment. If you can guarantee yourself 5% with 0% risk at all, 8, 10, 12% that you could possibly get on in the stock market or in some kind of real estate investment, sure, you could hypothetically make more, but you have to ask yourself how much risk you're exposing yourself to. Why is this landscape that I'm talking about right now so much different than, say, just 2-3 years back when the craziness of COVID was happening? Because at that time, interest rates were the lowest they've ever been, ever. So when these guaranteed like T-bills, for example, and you can only get 1-2% on your money, and you're able to get debt at so cheap, basically what happened was everyone was rushing capital into literally everything. Stocks exploded, real estate exploded, crypto exploded, the collectibles market exploded. That was then, and this is now. The reason I'm bringing this up also is to kind of forecast into the future, specifically the next 1, 2, 3 years. With that being said, I think we're going to continue to see liquidity leave the market. You're not going to see as much volume because people are going to be less inclined to risk their money and put it into the market when there's so much uneasiness right now. This leads to the next point of why I invest in the type of real estate that I do. When you have these patches where liquidity is leaving the market, where you post a house and maybe it is priced right, but there's just not the liquidity there. There's just not, the buyer pool is not as strong as it once was just a year or two ago. This is why cash flow investing is so important. and why I never buy for appreciation. Appreciation is nice, but cash flow is what keeps you through these times. So let's just say let's just say home prices do drop, right? Now is the time, this last year, this year, next year, however long it takes, 3, 4, 5 years, the cash flow can carry you through. Whereas when you do invest in these bigger multifamily deals, or you do speculation, whether it's stocks, Bitcoin, crypto, or speculative real estate investments, what happens is when something like this does happen where rates rise fast, you can call it a black swan event, but it does happen. The liquidity leaves the market, and now you're basically left holding the bag. With all that being said, this is also a great time. I think this is going to be a great opportunity, this stretch right here, to find great deals on homes if you do have the cash. If you do have the cash, now is the time to be looking for great deals, submitting lowball offers. Everything's on the table right now. To make a long story short, the plan is simple. One is to try to raise your cash position the best you can right now. That is the first thing that I'm focusing on. I'll speak for myself. The next thing is, while there's all this uncertainty, while people are wondering what to do, people are scared of the stock market right now, people are scared to make investments right now because they just don't know what's going to happen with rates. All of it is very dicey at the moment. That is the time to be aggressive with finding deals. That's exactly what I'm doing. So number one, raise cash position the best you can, get educated. Two, this year and next year is going to be the year of finding deals, especially as something I've talked about in previous posts, is as these adjustable rates become due. So people who do 1, 3, 5 year adjustable rates, those are all going to have to be re-underwritten this year, 2024 and 2025. So with all of these things happening at once, with T-bills being a great option, so people are going to take a safe option like that in a time of uncertainty. Liquidity is going to be leaving the market because we're not in the super 2-3% low interest rate environment we were before. A lot of people invested on appreciation. ARMs are going to be coming due. So now, in my opinion, is the time to be thinking about increasing cash position and being extremely bold while everyone else is fearful right now. So I'm going to end it on that. That's the video. I've just been seeing it everywhere with these T-bills and CDs and getting calls even from my own bank about them. I hope this was helpful. Again, I'm still working on the website. There'll be some resources down below to get connected, and I'll see you guys in the next one. The next video is going to be another behind the scenes of one of my deals. I'm just going to go deal by deal of all the transactions that I've done up to this point. So I'll see you guys in the next one.